at some point, I think it is likely that sellers start realizing that the Fed rate cuts is almost like trying to start a car, right? And it just doesn't, each time they pull the key, it doesn't start. And once that becomes understood, that buyer demand's on ice and is not coming back anytime soon, that is likely when you'll see sellers maybe begin to panic a little bit. I couldn't tell you exactly when that's going to happen, but that's the key point, understanding that shift in seller psychology from going from, I think I should get X for my house because I just should, to I better sell today because it's going to get worse in the future.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The U.S. housing market remains in uncharted territory. The median, not the average, existing home price hit yet another all-time high last month, yet transaction volumes are at lows not seen for decades. Potentially changing the game from here is that mortgage rates are likely headed downwards now that the Federal Reserve is cutting interest rates, and we're also seeing inventory starting to surge in an increasing number of regions. So what does this all mean for home prices as we head into 2025? Will we ever return to a normal housing market again? And what would normal even look like from here? Well, to find out, we welcome housing analyst Nick Gerli, founder of Reventure Consulting and creator of the Reventure app, back to the program. Nick, it's great to see you. Thanks so much for coming back on.
Great to be with you, Adam. We have a lot of interesting things to talk about with the housing market right now.
Yeah, from watching your recent videos, Nick, it really does seem like, okay, we're getting to the part of the story where things are getting interesting, where they're sort of starting to move fast and furious here. So lots to dig into. If I can, got a lot of specific questions, but just at a very high level, what's your current assessment of the U.S. housing market right now?
It's a combination of two different stories in two different regions. In the South, Sun Belt, and Mountain West, we are definitely seeing a downturn play out in those local housing markets. Inventory has surged, median list prices are declining, and we're seeing investors in particular sell out of a lot of these housing markets in the South and Sun Belt. On the contrary, in the Northeast and Midwest and parts of California, we still have a big inventory shortage, a legitimate shortage of homes for sale, which is causing prices to continue to go up. I just spoke to a home builder in New Jersey. He just said he got $100,000 over asking price for a home he just built in New Jersey. Meanwhile, down here in Florida, where I live, they're cutting the prices $100,000. So it really depends on where you are in this housing market right now.
Okay. But it sounds like some parts of the housing market are experiencing what you would call a full-blown correction at this point in time. True?
100%.
Okay. 100%. And then, of course, some other parts, it's still short inventory, bidding wars, et cetera. Let's dig into both of them. But let's see. Probably the most germane news to the housing market in the past couple of days has been the fact that the Federal Reserve has now officially pivoted on interest rate policy. And it just not only cut rates for the first time in several years, but it cut them, fairly largely. So we did a 50-point basis interest rate cut. I found it a little bit interesting that mortgage rates didn't move much on that news. In fact, the day of the announcement, the day of the Fed cut, they actually crept up a little bit. And I know that stymied a fair amount of people. The reason that I've heard that mortgage rates haven't responded all that much is because the decrease in mortgage rates commensurate with the Fed cut already happened. We're already priced in. That when the Fed coming out of the July meeting basically said, everybody expect us to cut in September, mortgage rates started trending down. And so therefore, it was already priced in by the time the Fed announced this. Is that your understanding as well?
100%. So mortgage rates are now back up to 6.2%, but it's important to understand that they've been dropping over the last 3 to 6 months. So mortgage rates actually peaked around 7.6, 7.7% in late 2023. The 30-year fixed mortgage rate, according to the Mortgage Bankers Association, got to 7.8. We are now down to 6.1, 6.2. So we've already seen a 160 basis point improvement in mortgage rates from their peak in late 2023. So to your point, Adam, much of the rate cut has already been priced in. And now we're seeing long-term bond yields are kind of stabilizing after this rate cut. So it's likely that for the next month or two, mortgage rates stay in their current range. And they could head down more in the beginning of 2025, maybe into the high 5% range. However, here's the important thing to understand is that to date, declining mortgage rates has not done anything to improve home buyer demand in America. We are at a 30-year low on mortgage applications to buy a house. We're at a 30-year low on pending home sales. And that's with these mortgage rates already dropping. So this is the big concern that I see is that Fed rate cuts and lower mortgage rates, that might not do anything to improve home buyer demand because it seems more and more like home buyers are on strike and that they're waiting for lower prices before they come back in.
And Nick, do you think it's that they're waiting for lower prices or that they just have to have lower prices, that they're just priced out, that even if they wanted to buy, they just don't have the means to do so now?
Yeah, thank you actually for correcting me on that point because you are right. They are not waiting. They are forced to the sidelines by the historic lack of affordability on the housing market today. The typical mortgage payment in America spiked up all the way to $2,900 a month for a home buyer, including mortgage interest, taxes, and insurance in late 2023. And you can see that figure has now come down due to lower mortgage rates. However, it's only come down to $2,600 a month. So we're kind of still at the same level we were in late 2022, early 2023 on mortgage payments. And you can see it's just, it doubled from pre-pandemic levels. And so this is quite simply not enough. It's not enough relief to bring buyers back into the market. Where I think we need to go, and we can talk about this more as the video goes along, kind of the threshold for where I think buyers are going to come back in, is this blue dotted line, $2,100 a month on the mortgage payment. That's, I think, going to unlock real home buyer demand. But to get from here to here, we're going to have to see even lower mortgage rates, and we're going to have to see prices correct meaningfully, probably on the order of 15 to 20%.
So Nick, super helpful chart. That only tells part of the story on the cost side though, right? So mortgage prices jumped, doubled pretty much like you said there. But at the same time, we've been seeing a lot of catch up from the housing price inflation in things like property taxes, costs of insurance, and maintenance and repairs as well. So it's not just the mortgage that became a lot more expensive, it's all those components, correct?
Yeah, definitely, Adam. And to be clear, that graph did take into account property taxes and insurance. However, your point is absolutely correct. Higher property tax bills, higher home insurance bills are something that are causing lots of homeowners across America to sell, particularly a lot of real estate investors. This is kind of the silent thing that we are seeing in the background right now of the housing market is many real estate investors are selling and they're selling to get out of the market while it's still near the peak. And this is something I'm seeing a lot in Florida. Because when you increase the carrying costs on houses so much, through higher taxes, higher insurance, higher HOA fees, in some cases, these investors and existing owners are being forced to refinance at higher rates. They can no longer afford it, and then they're forced to sell. I actually just found a listing down here in Florida that Blackstone is selling at an $80,000 loss. That's how big the real estate investor sell-off is getting. And if you want later in this video, I could show you some of the data on this investor sell-off. This has something that has the potential to cause prices to really drop in certain cities and neighborhoods.
Okay, so I'm smiling a little bit because this is a topic that you and I have talked about for, I don't know, Nick, probably close to 2 years, about something that we were concerned that we would see at some point along the timeline here, right? That as everybody was rushing in to buy these Airbnbs, these short-term rentals, during the COVID pandemic, it's like doubled the number of inventory in Airbnb, or at least the number of hosts doubled, right? So I think it's like more than 50% of hosts have come online since the pandemic. And we were concerned that a lot of these people were buying homes at prices that probably weren't going to pencil out for them, especially if demand started to go down, which we've certainly seen now with the short-term rental demand. And so we were worried that, okay, you're going to have this class of homeowners now who got in, many of them kind of dilettantes, in the short-term rental space, and with dreams of making lots of passive income. And all of a sudden, this thing is now making lots of passive losses for them. It's just taking money out of their pocket every month. That there was going to be a lot of pressure on those folks to sell. And it seems like we're at that point in the story I do want to differentiate between, kind of mom and pop individual investors investing in short-term rentals versus the big institutions like Blackstone, because I think those are related but different stories. It sounds like we're seeing interesting data points on both of them. So as you talk about seeing inventory begin to increase in these markets, what is driving that? Is it largely the short-term rental investor class? Are they the ones that are responsible for the majority of the inventory we're seeing come on now, or are there other dynamics in play as well?
That's a great question, Adam. And the answer is it's both. We're seeing both the big corporate investors start to sell as well as some of the small mom and pop investors. I would actually say the larger investors are being a little bit quicker to sell. And if you don't mind, I'm going to show you visually, I'm going to show your audience visually what this looks like, this sell-off we're seeing in certain parts of the US housing market right now. Right now, I'm looking at a map showing the inventory growth on the housing market by state over the last year. And the first thing you can see is every state is almost in red, meaning that we have growing inventory on the housing market. But take a look at this pocket here in the Southeast. North Carolina, South
Sorry
Carolina.
to interrupt, but A, those are big numbers. But more importantly, I just want to note, this map is coming from your reventure app, which you've designed, and I'm sure you'll be walking through as we go through this interview. So if folks are interested in seeing this data for themselves, they can go to reventureapp.com or reventure.app, right?
100%. Thank you, Adam. Yeah, this is www.reventure.app. This is a program that I designed and developed to help home buyers and investors track the trends in your market. As you watch this video, you're going to see the trends that are occurring. And yes, you can access it for yourself. But to your point, Adam, yes, these are big numbers we're seeing in the Southeast. 40 to 50% inventory growth in North Carolina, South Carolina, Georgia, and Alabama. 66% in Florida. We're going to have to zoom in on Florida a little closer just so you guys can see what's going on here. We went from 84,000 homes for sale last year in Florida, active listings on the market, now to over 140,000. So the data here on reventure app, it comes from realtor.com that tracks the active listings in the market. And you could see we're at the highest level of inventory for Florida in at least the last 7 years. So this is important to understand, is that the supply situation in certain states like Florida, as well as in a market like Texas, has changed dramatically. In Texas, we are now at the highest level of supply in at least 7 years. And so if you're a home buyer and investor out there, lots of people are still banding about narratives about low supply, housing shortage. Understand that that is no longer the case in many parts of America. We have excess supply now on the market in Texas and Florida, Tennessee. We're getting there in the rest of the Southeast as well as the mountain states. And yes, Adam, this is through a big sell-off from investors as well as home builders continuing to deliver a large quantity of units throughout the Sun Belt and mountain regions of America. The number of homes for sale by builders in the South is near 300,000 right now. That's even more than it was in the '06 bubble. And so we have these different factors percolating in these, let's just call them pandemic boomtown housing markets that are now starting to turn into actual price declines. And this is the thing I want your audience to understand, is that this is no longer theoretical, that this is actually happening. Part of the reason I moved down to Florida was so I could be here on the ground to see what's actually happening with my own eyes. And every week I find new listings where prices are being cut 10, 20, 30% in some instances. And in some cases, they're coming from these big, big Wall Street investors. If you don't mind, I'm just going to show you this one in Wesley Chapel, which is a nice neighborhood north of Tampa. Over 100,000 median income in this neighborhood. This house for sale for 415,000 is being sold by Blackstone. The way we know that is because the entity that owns the property is SFR Acquisitions 2 with an address at 120 South Riverside in Chicago. That's a company called Home Partners of America, who Blackstone purchased 3 years ago. So Blackstone is the seller on this house. Now you take a look at the listing history and what do you find? They bought it for 490,000 back in April 2022 at the peak of the bubble. Blackstone bought this house for 490. It's now listed for 415. So they're taking a $75,000 haircut, 15%, in not even 3 years. And I'm just finding more and more examples of listings like this down here in Florida. I'm also seeing it happen in Texas. I'm also seeing it happen in Arizona, parts of Tennessee as well, There's definitely something big going on with some of these big investors selling and selling at losses. You can start a whole conversation about what this means for the housing market in the future. Why would Blackstone be selling at a $75,000 loss in less than 3 years? It has to do with skyrocketing inventory, a worsening rental market, as well as what you said before. The property taxes, the insurance costs, they're going up. And it's now no longer profitable for many of these investors to operate their investment properties.
So again, Nick, this is exactly what you and I were talking about, over the past couple of years, that we saw an increasing probability that this could happen, and we were concerned that that if it did happen, it would have big repercussions for home prices. It seems like everything we talked about is now looking like it's underway. So the investor capital is oftentimes called the smart capital, right? These are the smart guys with other massive quantitative models. And I remember, not the last time you were on, I think the time before then, Nick, you were saying, yeah, those guys have actually stopped buying in most of these markets. And it now seems like not only have they stopped buying, but they're actually starting to unload properties. And one of the things that we talked about being, one of our concerns about the high relative concentration of institutional owners in the markets this time around, much higher than it's been in previous housing cycles, is that as you can see, these big firms like Blackstone, they're not just owning multifamily properties, they're now owning individual single-family homes, right? And so when they were buying, they were basically out competing people that wanted to get a house, right? So they're responsible for helping drive prices up to a point where, the vast majority of aspiring home buyers can now not afford a house. But they're also, to them, these homes are a line item in a spreadsheet. So if times start getting tough, if you live in the home, you're really wrestling with, do I sell this property? Because if I do, I got to go figure out another place to, have a roof over my head, right? Where for an institution, they're just like, oh, wait, nope, this didn't pencil out the way that we thought. All right, just sell it, right? So they're a hair trigger. And so they can dump the houses very quickly, but also a lot of these institutions own a lot of inventory, oftentimes in the same market or markets, right? So they can, if they decide, yeah, we're just going to cut bait, they can actually flood a market with a lot of inventory very quickly, and they'll just lower the price as far as they need to get it to move, right? They're just trying to liquidate it and get it on and move on to their next investment. So it seems like that might be underway here in some of these pandemic boom markets.
It's definitely underway. And I just want to add some further substantiation to this, Adam, because I know I just showed you guys one listing, and I'm going to show you some more listings in a second with massive price cuts in Florida. You guys aren't going to believe how much these prices are going down on certain listings. But I want to show you that data on the investor purchases overall, because it helps substantiate the story and helps show you really what's going on. So, Redfin releases a home buyer investor report every quarter. And you can see here, they show that the investor purchases went up 3% year over year. But what that masks is the fact that the nominal amount of investor purchases, you can see the big spike. This is when the investors were buying during the pandemic. Yep. Well, now they're back down to a level that's similar to what they were at in 2017. So the investor purchases are down to a 7-year low, way down from their pandemic peak. So, the investors, and this has happened like a year ago. They kind of stopped buying a year ago. But this is now the new trend, is the investors selling. This is another listing in Punta Gorda, Florida. This is owned by a Wall Street investor called First Key Homes. I went down and visited this property 3 months ago. They cut it down to 336. It still hasn't sold since I went and visited it 3 months ago. You can see here the Zillow value estimate. They bought it for $445, May 2022. Now it's on the market for $336. Very similar story to the Blackstone story. And what then happens is, as these investors really start selling in certain neighborhoods, like you said, Adam, they can then really drag down the prices, because housing is all about, the marginal buyer, the marginal seller, the next buyer, the next seller. So if you're on a block and all of a sudden one house goes from 500 to 400, anyone else who wants to list on that block and sell their house is going to have to follow suit. So we're seeing more and more sellers begin to wake up to this reality. Now, I want to be clear. On a national basis, yeah, prices are still at an all-time high. They're still going up in about half the states in America. But in these pockets that really boomed during the pandemic, we are now seeing this downturn begin to play out. I'm going to show you one more listing, if you don't mind, folks. This is actually not an investor, but this is what's even scarier. Is this is also in Punta Gorda. It's a 3-bed, 3-bath, 2,500 square feet. It's on the market for $295. And I want you to take a look at how much the Zillow value estimate has fallen on this house. It was originally listed for $520. They have since cut the price to $295.
Wow.
This is now at a value that Zillow said it was worth 10 years ago. You can see Zestimate up 4% in 10 years. We have now erased not only the pandemic appreciation on this house, we're back down to what it was at basically the last crash, coming out of the last crash. And you can see just some of the price cuts on here are just insane. I looked up this house. It's not an investor. It's actually an estate sale. So it's an estate sale. And that's the other thing about Florida in particular, as well as you can make an argument about the aging of the U.S. population and what it means for the housing market. On one hand, we have investors who are very willing to sell and cut the price when the time is right and when they feel compelled to do it. The other case where people do that is on estate sales. There's a real demographic situation going on in America right now where the homeowner population is aging. More homes are getting passed down to their kids. The kids don't want the home. They just want to get rid of it. And they have a similar mindset. It's kind of like, I don't want to deal with this. Sell it, price it where you need to sell it. And these are trends that are really going to start to push down home prices in many parts of America.
Okay. My arm's getting sore from patting ourselves on the back about this, Nick, because we have talked about this too in the past. I'm really glad you brought up this point, because I think we're going to see this on an increasing basis in more and more markets where the boomer generation has not downsized yet in the way that it was expected to, but it is going to have to, right? That's just a force of nature. At some point, these people are going to have to move on into assisted living, nursing home, whatever, and they're going to have to vacate their current primary residence. And then, yes, an increasing number of them over time are going to start dying, right? I don't think we're certainly not close to the peak years in dying yet for the boomer generation, because we're still at the point where the younger ones are hitting retirement age at a rate of about 10,000 every day. But not too far in the future, 10 plus-ish years or so, it's going to be 10,000 dying a day. And then to your point, we're going to have an awful lot of estate sales. A much higher percentage of transactions will be estate sales than what we've been used to. And to your point, those are just price it at whatever it's going to take to sell. Because me and my siblings, none of us, is choosing the house. We think the fairest thing is just to sell it and split the check. So it's I don't want to call it a price insensitive buyer, but it's certainly a much more seller, but it's a much more price insensitive seller than we've had in the market normally.
Yeah, 100%. And I want to actually address the flip side of this comment, because I know that a lot of people out there might be looking at these listings and saying, hey, this isn't happening in my housing market. Why am I still seeing sky high prices? And you have to understand seller psychology. Sellers often don't pay attention to the market. Usually how a seller prices a house is they already have an idea in their head of what they want their net proceeds on the sale to be. They probably have already baked into their mind that their house is worth, say, 600,000 because they saw their neighbor sell for 600 grand 2 years ago. And then they said, okay, I got a 300,000 mortgage. I'm going to pay the realtor. I'm going to get 250 from this transaction. They made their mind up 2 years ago on that. So even though the market has shifted, many sellers still go to market and against their realtor's advice, they'll go to market at the sky high price. And so you're still seeing a lot of that in the market today. I want to be very, very clear. Prices are still near an all-time high in an aggregate basis. They've only gone down a couple percentage points in many of these markets. But you just hit a key point, Adam. The more price insensitive the seller gets, the more that causes the market to break. An investor is not romantically attached to their house. They just want to price it to sell. An estate sale, they're not romantically attached to their house. Maybe in some cases they are, but usually not. They'll price it to sell. And I think we're seeing in Florida right now a preview of what we'll see in other parts of America. And we're back to reventure app here. And we're actually looking at a demographic metric, median age. So where will this silver tsunami sell-off occur first? Well, it's going to occur in the older parts of America, Florida, West Virginia, the Northeast. We have not actually seen inventory increase in the Northeast yet. We still have a big shortage, but I actually just want to zoom in a little closer on Florida so you guys can understand what's at stake. We have some metros here, like Northport, Sarasota, where the median age is 54. Punta Gorda, it's 60. Naples, it's 53. Port St. Lucie, it's 48. So in these areas in red, they have an older homeowner population with a lot of investors and home builders. That is the cocktail for a massive sell-off where prices are really, really going to drop. But again, to be clear, the housing market's regional. So if we switch now to the inventory surplus or deficit, which is one of my favorite metrics to understand, is inventory above the long-term norm or below the long-term norm? We can actually see here in the Midwest and Northeast, inventory is still in a big shortage. In Illinois, inventory is down 41% from its long-term average. I mean, think about that. I thought everyone was leaving Illinois. Doesn't appear that way. Home buyers are still there. There's a shortage of listings on the market. Same thing in New York, 26% inventory shortage. So, we see the inventory shortage here. Then we look at the median list price. We see it's the inverse. The median list price is still going up in the areas where there's the shortage. Conversely, where inventory is now in a surplus in the Southeast, Texas, we look at median list price, inventory is dropping, or median list price is dropping. And so you can now see on median list price, prices are going down in about half of the states in America: Colorado, Texas, Oklahoma, Tennessee, Florida, Idaho, Oregon, still going up in the Midwest and Northeast. So also just so important that people understand the specific local dynamics in their housing market, because while there is the national story on all the things we're talking about, there are still huge, huge regional differences.
Absolutely. And that's, what makes real estate so interesting is that everything is so local, but there are trends that, some of the trends we're talking about are going to be very specific to some of these boom towns. Some of these trends we're talking about are going to spread eventually to the whole country. So I really want to try to tease out what folks need to be looking for versus what they need to maybe worry a little less about. But I got a couple of questions here. I want to go on a little journey here to get to a big question. So in these boom towns, there's sort of a perfect storm, right? There's inventory is increasing, but the builders who have been building projects in those areas still want to finish those projects and sell them for whatever they can get. So while inventory is coming on organically, there's also the inventory coming on from these development projects. So you're getting a problem with too much inventory. You then have the institutional investors getting out, as you mentioned. You then have the short-term rental people beginning to sell, as you and I have mentioned. And in some of these markets, particularly the ones in Florida where they have an older population, you're getting sort of this downsizing / estate sale dynamic going on. So for those markets, if somebody's watching this in Austin or Dallas or Nashville or Punta Gorda or Boise or whatever, what inning do you think we're in here? Like you showed some of those charts where things were really beginning to fall off price-wise, right? Have we hit halftime yet? Are we still pretty much in the early innings, or do you think this thing's almost played out?
It's a great question. In a market like Austin, I think we're probably in the 5th or 6th inning at this point. Prices in Austin are down 20% from peak. Probably have another 10% to go. In maybe Florida, I think we're only in the 2nd or 3rd inning. I think we got a lot more to go. But if I had to actually give some concrete advice to people, and actually, to be clear, I can't really give financial advice, but just if it were me in the market with what I'm seeing on the ground and with the data, if someone wants to buy a house, understand that certain listings now are getting huge price cuts, right? So on aggregate, values are still high. Many sellers are still listing way high. But there could be an initiative or a strategy where you tell yourself, I'm just going to lowball. I'm going to lowball sellers in markets that I know are going down, that have excess inventory and excess days on the market where the seller's more desperate. I'm just going to lowball at 30% below asking price. And you might get laughed out of the room. Most times you do that. But then you might actually find a seller who accepts it. And
right.
so
or have a seller who laughs and then 3 months later comes back to you and says, hey, you know what? I haven't been able to move this thing. How about that lowball offer you gave me?
Yes, because I'm just seeing more and more individual listings that are down to, let's just say down to 2021, 2020 levels, in some cases down to 2018 levels. You're only seeing a handful of those listings on Zillow in the market, but if you just go and make offers, we're also seeing more and more sales just trade after the fact at a price way lower than list. And so what I would say is if you're a home buyer, understand what your budget is, number one. Understand what you feel comfortable spending, both in terms of price and down payment and monthly payment. And then circle that number and then see if you can make that number work in today's market. And then don't deviate from that. And in some cases, you'll get laughed out of the room. In other cases, you might actually find a house at a pretty good deal that matches the price you're willing to pay. Of course, there's the caveat. If you buy into today's market, even at a discount, values can keep going down
Right.
even after you buy. And that's something that no one really wants to do, right? You've been saving your down payment for years. You view your house as an investment. You don't want to see the value of your home decline. So there's some additional metrics you can look at, like how overvalued prices are, to see how much additional downside there is. And in the case of Austin, since Austin is kind of the most mature housing downturn market, I think it's a really interesting one to look at. Because at this point, reventure app has prices is only 13% overvalued in Austin. And you can see they're still 30% overvalued in Dallas, but we've actually made a lot of headway in Austin in terms of home price declines as well as some income growth and bringing this market closer and closer to fair valuation. So on this graph, if we're above this dotted line, we're overvalued. If we're below this dotted line, we're undervalued. You can see for the longest time, Austin was basically just more or less a fairly valued market, maybe slightly undervalued the last 20 years. And then we had the pandemic boom. We were 48% overvalued. Now we're only 13% overvalued. So I still think there's some downside in Austin on this overvaluation. Expect prices to go down some more. On our price forecast, we're saying prices will keep going down in the short term as well. But this would be a market in Austin where if you can get something for 10 to 15% below asking price, you might say to yourself, I have a decent deal. So that's kind of how I would answer that question. Whereas conversely, if you were to go to Dallas, I think Dallas is a market that still has somewhat of a long way to go. So in Dallas, we peaked at 46% overvaluation. We're still at 30% overvaluation. So I think Dallas, there's definitely still some wood to chop to get prices back to a fairer level.
Okay. And look, I really appreciate you focusing on that, because the old saying, price is what you pay, value is what you get. You're basically saying that after many, many years of values getting worse and worse and worse for the average home buyer, we're now beginning to see in certain markets the trends starting to tip into buyers' favor. And maybe not quite yet a fairly valued market, but you put in a lowball bid, like you said, you can basically say you can give yourself the parameters to get what you consider to be a fairly valued purchase. And what's probably also adding tailwinds to this, let's say somebody uses your strategy, Nick, right? Let's say they buy in Austin and they put in a bid that's 15% lower than the current price, and they eventually get it. Hopefully prices stabilize there, right? Which is what you would sort of think they would. But also, if the Fed continues cutting interest rates, if you were to buy that property soon, you'd be getting the additional tailwind of being able to refinance at some point at a later date at a lower rate than what you're buying in today, right? So you'd actually be having the Fed giving you a tailwind in this case.
Yeah, that's theoretically possible. I always try to be somewhat careful about prognosticating the interest rate situation, just because I heard so many realtors say for 2 or 3 years that you should buy now. What's the expression? You marry the house,
Marry
date
the
the
house,
rate.
date the rate. Yeah.
And then that didn't turn out so well for certain home buyers. I think you're probably right, though.
Yeah.
Interest rates are probably now kind of on the downswing. We'll have to see with inflationary pressures where all of that goes. But it certainly seems fair to say, at least for the next year, we're not going to see interest rates be like, they're probably not going up. I feel probably pretty good in saying that. Likely to continue to go down, could help you out as a buyer. Now, I think the really interesting question is, what does this do to home buyer demand? So, we've established so far that the initial interest rate cut and the mortgage rates going to 6% hasn't done that much for home buyer demand. And I'd like to also show you a graph on this because this is an important thing to understand because there's a lot of talk about, I see a lot of articles about housing market sentiment improves due to lower mortgage rates. But here's the reality of the situation, folks. We were at a 7.7, 7.8 mortgage rate in October 2023. We're at a 6.1 mortgage rate today. This yellow line is the mortgage purchase application index. What do you notice? We've seen a little, let's just call it a miniature bounce the last couple of weeks. But in reality, we are no better off on mortgage demand than we were a year ago. In fact, we're actually lower than we were in 2022 by a substantial margin when mortgage rates were even lower than they are today. So I don't know, like it's kind of a lot of people are taken aback by the fact that mortgage rates have dropped significantly in the last 5 months, and there's been really no meaningful bounce back in buyer demand. And so that's the thing I'm going to be watching. Like, are we going to eventually see a spike in buyer demand here? This mortgage application data comes out every week. I track it on my channel. But so far the data seems pretty clear. Buyers are on strike. I actually polled my audience on YouTube. I got 19,000 votes in this poll. I asked, mortgage rates dropped to 6.1%. Does this make you more likely to buy a house? 91% of people said no. 19,000 people voted. Tremendous cross-section of buyers, investors. So there's a potential scenario here where buyer demand does not come back for a while until prices drop.
Yeah.
And even when prices start to drop, we're seeing in Austin, we're seeing in parts of Florida, that doesn't even necessarily bring the buyer back right away either, because almost the sentiment in the housing market shifts in a way where then all of a sudden it's like, well, okay, now I have a lot of options. Now I'm hearing in the news about a condo crash, about an HOA crisis, about home prices going down. Well, I'm just going to pump the brakes a little bit and wait and see what happens, which is what I think a lot of home buyers are doing right now.
Well, and that's historically the pattern, right? Home prices, they move more slowly than stock prices, right? So you can have a flush out in the stock market, hit bottom, and then, start rallying again in the course of a couple weeks, right? Housing takes usually quarters to years to do that, right? I mean, previous housing corrections have generally lasted years, right, Nick?
Let's just say from 2007 to 2012 was the last downturn. It took 5 years for prices to go from peak to trough. In the early 90s, there was various regional housing downturns in America. New England got hit very hard. California got hit very hard. In California, prices dropped from 1990 to 1996, particularly in Southern California. So yes, once the downturn starts, it can be just like a slow grind down. And I think what happens is two things. One, during the boom, we pull forward buyer demand during the boom. So during the boom, interest rates are maybe at a lower level, economy's doing great or doing okay. People then all pile in. It's almost like we borrow demand from future years and put it in during the boom. That leaves
I think
an
it's exactly
overhang.
that way. Yeah.
Yeah, that then leaves an overhang in demand for the next several years. So right now we're 2024 entering 2025. There's a lot of people who bought during the pandemic who probably would have waited to buy until now, just on their normal course of life. But because the pandemic happened and then mortgage rates dropped 3%, they decided to buy in 2021. So we're just kind of missing those buyers, right? I think the other thing that happens is buyers who haven't bought yet get so discouraged by how frustrating the market is in terms of how high prices are, how obstinate sellers are and stubborn sellers are, that they eventually just kind of switch it off. I mean, I have family members who are looking to buy, I have friends who are looking to buy, and it's basically that way for a lot of them. They looked for 2 years in different cities around America, and they basically just threw in the towel and they said, you know what? Screw this. I don't want to do this anymore.
And surveys show the majority of renters have given up on ever being able to own a home. Like they have just flipped that switch, like you're talking about.
Which is a crazy statistic. I mean, that's not a great statistic, right?
No,
I
not
certainly
healthy.
I certainly have more hope for the average renter buying a house over the next 3 to 5 years, but I totally understand why they would feel that way with sky high prices, record worst affordability. And then often in the media, inaccurate coverage of actually what's going on in the housing market. And you know, a lot of times, unfortunately, in the media, they don't talk about the things we're talking about in this video, and some of this stuff goes underreported on the improvement in affordability that's now occurring in certain parts of America.
Yeah. So there are two other factors in the mix here too. One is psychological, which is it's sort of why central planners fear deflation, because when people think prices are headed down, they then rein in their purchasing because they're going to hold their money to wait for even lower prices tomorrow. So as people start seeing home prices corrections go on in their local markets, they begin to develop that wait and see mindset. Right. Well, I could buy today maybe, but let me give this another month or quarter or two to see if I get an even cheaper price. Right. So that can come into the mix. And then secondly, too, you know, there are economic ramifications here too, right? As you know, prices start coming down and people start experiencing the negative wealth effect of housing, they rein in their spending. That impacts corporate profits. Companies may have to lay people off more, and then people get more concerned about losing their jobs, and they tighten their purse strings even more. So my point is if a recession happens at the same time, and there does tend to generally be correlations with recessions and home price bottoms or home price troughs. If that happens, then you have the economic elements as well pulling things further down. So the point being is that yeah, you shouldn't be expecting to jump in and you know have the market rally dramatically. If you are buying while the momentum is going down, you need to be aware that it continued to go down for a good while, or at least trend sideways for a good while before you see any appreciation. I also just want to mention too, because you were right to do it. I just to be super clear, I don't recommend that anybody buy a house with the expectation that interest rates have to come down for you to get the return on the house that you want when you buy it, right? That should just be looked at as a bonus if it happens. So
Right.
don't count on the Fed to rescue you here. As I said, I could see the conditions where it could be helpful going forward, but do not make that a requirement that it has to happen if you're factoring that into the math of buying a home. All right, so Nick here. So
Hey, Adam, do you mind?
yeah,
You mentioned something on the deflationary mindset,
yeah,
and what that, and I just want to show in one more listing, if
sure.
you all don't mind, because it speaks to what's going on in Florida, particularly in the condo market down here. So the condo market has entered a downturn. I think the median condo list price is down 5%, is what Redfin and Zillow say. But again, on certain listings, we're just seeing a free fall. And what's entered people's psychology now down here in Florida with the condo market is even though prices of condos are dropping so much, people don't seem to care because they know that it's a downturn. And so this is a condo here in downtown St. Petersburg, and this is one of the nicest located properties. It's a bit older. There's some HOA assessments coming, which is why the prices are dropping. One of the reasons. But I just want to show you again, just another example of just value getting wiped out. So
Wow,
we,
almost cut in half.
yeah. So Zillow thought this was worth 695 in early 2022. Current list price is 399. It's pending. We'll see if that happens or not. But right now we're at a similar value to what we were at in 2017. So we wiped away 7 years of appreciation on this condo. There's some other ones in this building here that are doing the same thing. A lot of condos down here in Florida are going down. This is one of the more extreme examples, but I've now shown you what, 3 examples in this video of listings where prices are back down to where they were 5 or 6 years ago. And so deflationary mindset, when this starts taking over and people start seeing these type of listings, yes, it does cause them to say to themselves, like, I'm not going to be in a rush to buy. So that is definitely a situation I'm seeing down here in Florida to address that point on deflationary mindset.
Okay, so you know, again, Florida probably ground zero for all these many different shoes that are dropping that we're seeing in some of these COVID states. But as you said, lots of the country aren't experiencing this, right? So where I want to get to, Nick, is sort of like how worried should somebody be if they're living, you know, in one of those states that aren't experiencing this yet, that are still seeing price appreciation, still having uh, inventory shortages. Um, you and I have talked a lot about inventory in the past, and I think we think there's more inventory out there than most people think. And that's because it's been owned by institutions or investors or whatever. Um, but obviously it's all different. Some markets have more, some markets have less. Um, do you see this increase surge in inventory that we're seeing in the Southeast and Mountain West markets? Is that something you expect to metastasize eventually into many other markets, or is it really going to be regionally contained?
It's a great question. It's one I flip-flop on, because if you had asked me that question a year or two ago, I would have said I totally expect this to spread. I still do expect it to spread, but the resiliency of some of these Midwest markets in particular, I mean, at this point, it's kind of shocking how in a market like Illinois, there is almost no homes for sale. So we go to Illinois, we have 20,000 homes for sale. Before the pandemic, there was 57,000. And so we haven't even gotten back, like inventory has barely increased in Illinois. So I say in a place like Illinois or a place like New York State, to be clear, New York State's a bit different from New York City. New York State, we went down 65,000 homes before the pandemic for sale. Now we're at 35,000. When I look at this inventory graph, I have a hard time seeing like imminent declines, right? We're going to have to see on a month by month basis. You can see in New York, the inventory has already peaked for the summer and is now starting to flatline again. I just have a hard time seeing prices dropping in the near term. But the good thing on reventure app is we track that through a home price forecast score. And so every month we take inventory and price cuts and days on the market and recent appreciation mortgage rates. We combine it into a score to kind of show how much of a buyer's or seller's market it is. You could see in New York, kind of we went to maybe an equal market in late 2022 when the downturn started. Now we're back into a seller's market. So if you're a buyer in New York, the way to look at it would be like, am I seeing it turn back down into a buyer's market like it was before the pandemic? Right now, the clear indication is no. Month by month, maybe in 6 months, 9 months, it starts changing. But for now in New York or in New Jersey, we can see we're not even close to entering a buyer's market in a place like New Jersey. And so that's, maybe not what a lot of people in these states want to hear. But yeah, we're forecasting at reventure app prices to continue to go up in Connecticut, New Jersey, Illinois,
Uh-huh.
New York over the
Can
next 6
you
to 12 months.
you have a measurement there of market affordability, right? Or
Yes.
affordability by market? Yeah. Can we try that?
So yeah,
Because I
there's two
guess
ways there's two ways to think about it. One is the overvaluation rate, which looks
yep.
at the historical home value to income ratio. And so there is a slight correlation here. You can see the Midwest and Northeast is not as overvalued. So New York is 14% overvalued, Pennsylvania is 11% overvalued, Illinois is only 5% overvalued compared to its long-term norms. And so, you know, less overvaluation means obviously less likelihood of a crash, also means more support for prices into the future, right? Illinois, we were very overvalued at the peak of the last bubble. We were then undervalued for a while, all the way through the pandemic. Now we're slightly overvalued. So that's one measure of affordability. Another measure of affordability is looking at the mortgage payment as a percentage of income. However, I don't actually think this does as good a job at telling you actually what's going on in the market right now and predicting what's going on in the market right now. Because the Northeast is not affordable, but relative to what it is normally, it's not that different from what it is over the last 2 decades. Whereas the South, the Sun Belt, Georgia, Tennessee, Florida, Texas, all the way up to Montana, we're very stretched on valuations compared to what we normally are.
Okay. So the reason why I'm asking all this is like I've got family in the Northeast. That's where I'm originally from. And they are still gobsmacked at how expensive prices are there and how much they have, risen in the past decade plus, right? And it is the message to them, sorry guys, but this thing's still got room to run
Yeah,
here.
are they in Connecticut?
Connecticut, Massachusetts, more Massachusetts, but yeah.
All right, so okay, so Boston, this is a great example, the Boston Metro, right, which is pretty big, goes up into New Hampshire. Typical home value of 696,000. So yes, you can see it is accurate to say we're at an all-time record high price. However, if you look at the home value to income ratio, which is really what matters, home prices relative to income, we're not as at crazy a multiple. So the average is 5.4 home value divided by income over the last 20 years. We're at 6.2 today. So yes, it's fair to say Boston is expensive compared to what it used to be, but we're 16% overvalued. So maybe you could say to yourself, there'll be a mini correction. Maybe you'll say to yourself, this market might just stop growing for 7 years while incomes catch up. But it's just not actually that overvalued compared to what it used to be. Whereas when you go down here, Atlanta, 33% overvalued, Charlotte, 31% overvalued. The prices here are cheaper in Charlotte and Atlanta, but they're more disconnected from what they were historically, which is typically the sign of a bubble. And of course, you add in the fact that they simply don't build any homes in Boston, the Northeast, and you get a situation where the inventory levels are still below normal.
Wow. Yeah, it looked like it was what, minus 20% there for Boston. That's inventories are below what there? Is that the historic
Yeah,
norm?
exactly. Yeah, so it's basically, let's just say the current for sale inventory 5,700 for August heading into September is currently in 2024 on average it's 7,000. So we're 19% below the average inventory level. In Albany, we're 44% below the average inventory level. In Hartford, we're 56%. So I also think there's something interesting here to say about migration, because everyone's still talking about the fact that everyone's moving to Florida and Texas and the South, but I don't think that's happening to the same degree. Because why would inventory be so high, or I should say above normal in these states and so low in these states? I think we're probably seeing some type of reverse migration situation also play out, in addition to the points that we've discussed about home builders and investors.
Yeah. Well, let
There's
me ask you
probably
this,
less
Nick.
people moving. Yeah.
Yeah, let me ask you this. This is just a hypothesis, so it might be a bad one. But is this an artifact of the work from home movement where, people sort of flooding out of places like New York City? Yeah, a lot of them went down south, but there was more space to absorb them down there and more building to absorb them. But some percentage went east, say into the Northeast, and there just was much less inventory to absorb those people. So at a marginal level, they had a much bigger impact on driving home prices up and supporting them there.
You could very much be right about that. So I'm actually from the New York area originally, and I've thought about this too. So you can see in Manhattan, inventory is basically normal, slightly below average. But then Westchester County, it's 49% below average. Fairfield County, Connecticut, 57% below average. Bergen County, New Jersey, 49% below average. These would be the counties where the New Yorkers would flee to, right? I think you actually just brought up a great point, Adam. Very clearly, these were the counties that probably absorbed just as much migration as Florida did. And I still think probably there's people making this move, right? From New York City to the surrounding counties. But these people from New York City have stopped or slowed significantly moving down to Florida, which is why we see inventory in Osceola County, south of Orlando, 74% higher than normal, which is why inventory in Pinellas County, west of Tampa, 66% higher than normal. Take a look at this. If you don't mind me showing you this, this is the county I live in down here. We went from 3,200 homes for sale a year ago to 6,500 homes today. Before the pandemic, it was 4,900. I mean, this is unprecedented.
So it doubled in a year, right?
Doubled in a year. It's also what, 20% more than pre-pandemic. So, the one market that does seem to be holding is Miami-Dade. Miami-Dade inventory has spiked, but we're still below pre-pandemic. I don't think that's going to last, so I think Miami will eventually go down. But yeah, I think we got to a kind of a solution here. Less people doing that, moving across the country, migration. Probably still a lot of people doing the moving from a city to the outlying county.
Yeah. Although what's interesting about that is, so it maybe has had the effect that we're theorizing about here, but now we're beginning to see headlines of companies getting more serious about return to office.
Yeah.
And I guess that's one question you just got to ask yourself. So if you're in one of those counties you showed, outlying New York City, what if some material percentage of your, residents that moved there in the past couple of years either get called back to the home office in Manhattan or get laid off. Oh, you're unwilling to come
Mhm.
back? Fine, you're done, right? And you just have to be careful that if all of a sudden there's either an emigration or a rise in unemployment amongst those newcomers, that might actually that could actually impact home prices negatively in your area, right?
That's a great point. I guess the question is it going to be 5 days a week fully in the office? I think that's what Amazon's trying to do, right?
Right. And some of the banks, I think, have done that too again. Yeah.
And some banks, if you're in Westchester, you can still take the train to New York City. Maybe you move to Northern Westchester, it's an hour train ride. You might not like your life, but you could still do it. If it's 3 days a week in the office, you could still do it. But what you definitely can't do is live in Florida and do that.
Yeah.
So I would say if this kind of end of remote work or decline in remote work continues, the first order impact will be the same thing we just discussed in this video. Texas, Florida, Tennessee, Arizona, Nevada, those states are going to get hit because a lot of those people are going to have to move back to where they came from, or they're going to have to quit their job and figure something else out. Second order impact maybe would be the outlying county, maybe an hour away, 2 hours away. Eventually, some of those people might need to go back as well.
All right. Well, fascinating. Well, obviously, Nick, will have you on again in the future, and we'll track this as and however it happens. All right. So if we can bring this full circle, Nick, can we go back to the chart that you pulled up at the beginning of the increase in mortgage rates? And I guess it was the all-in number, more or less, mortgage rates, property taxes, insurance.
Sure, let's
Because
do it.
there was a threshold on there that you said, I think this is maybe if it falls to this level, that's going to unlock the market. And the question I have for you is what's going to be in the driver's seat, do you think, for markets that do have some sort of price correction outside of the hot COVID markets we've already been talking about? Is it going to be inventory that's going to drive the change, a rise in inventory? Is it going to be prices that drive the change, that prices are just going to have to come down because nobody's buying? Or is it going to be rates, lower mortgage rates? Like, which of those three do you think is going to be in the driver's seat more?
It's a great question. In a market like California, I think you're more likely to see the second point where California is very price sensitive. So changes in demand often just lead to changes in prices, even if inventory doesn't move that much. I wouldn't be surprised if prices in California go down just because the buyers are just not there. And the point about mortgage rates was an interesting one. One potential consequence of lower mortgage rates could be that we unlock a lot more inventory. And this
Yeah,
is
I
a
think that's going to
topic that
happen, just FYI. So yeah.
I've definitely heard you talk about. I don't hear too many other people talking about it, though, is the idea, if you don't mind, I'm going to just show you the inventory graph real quick. So nationally, we're at 909,000 homes for sale. It might grow a bit more in September before it hits its seasonal peak, but we're up 36% year over year, and we're now about 26% below August 2019 levels. So inventory is getting there, right? And of course, we talked in this video about how it's a tale of two housing markets, right? In the South, inventory is already here and higher. In the Northeast, it's still down here. But if mortgage rates continue dropping, say to 5.5, we're going to unlock a lot of sideline sellers
Mm-hmm.
on the market. And what people often don't realize is those sellers, yes, many of them will buy another house, but they're going to have to sell their house or at least find a buyer and put it under contract before they could buy a new one.
Yep.
And so if you push that situation into markets that are already heading in a downturn and have excess supply, you could cause inventory to go up in a way that's probably hard to even imagine right now. Think of all the sideline sellers, all the people locked into low mortgage rates who are then going to be unlocked. They're going to list their home. Yes, they're going to look for another home, but they're going to potentially be listing already into a down market. And that's a scenario I don't know if we have any historical precedents for exactly how that's going to impact the market, but it could cause inventory to go up by even more. And we'll see what that does to prices. But I think that's something that's going to be a real headline in 2025. Don't be surprised if inventory goes through the roof.
All right. You've heard me say around this, Nick, that there is a first mover advantage in that scenario if you're a seller too. right? That it kind of to date, the sellers have been, somewhat trapped in their homes, as you said, right? They've been locked in. But also they've been kind of colluding like, okay, let's nobody sell here, right? And let's not bring prices down in our area. And let's wait for the Fed to rescue us, right? And bring interest rates back down, right? But if you are seeing the trend in your market, is likely to continue to the downside, and you're getting to the point mortgage-wise where you're actually not so locked in anymore, there's a real first mover advantage to be one of the first to list. Yeah, maybe you got to bring your price down 5, 7%, whatever, but you escape with the vast majority of the equity you have and you get the house you want, right? Once that starts to happen, once you start seeing people bolt from the herd, those first movers, then the rest of the herd of sellers potentially starts panicking and saying, well, wait a second, I don't want to be the guy who rides this thing all the way down. And you get exactly what you're talking about there, right? That surge that nobody's expecting.
Right. And when does the seller psychology shift in a way where sellers stop thinking about the net proceeds they had in their head 2 years ago when they saw their neighbors sell their house? When does the seller psychology shift from that to, oh, I better sell today because it's going to get worse 6 months from now? That's the real question in terms of the broader housing market downturn, because I'm witnessing it down here in Florida. It's just so interesting how, over here we have Blackstone selling at 415 grand. It's a 4-bed, 3-bath, 2,200 square feet, right? Down the street, there's a neighbor selling for 412, 3-bed, 2-bath, 1,500 square feet. That's laughable compared to the Blackstone house, same price, 800 square foot bigger. So
Yep.
we, on one hand, have a seller motivated, cutting the price. Just down the street, we have a seller completely detached from reality, not understanding it. And then their next door neighbor is more attached to reality. They have a 6-bed, 3-bath, 2,600 square feet for 480. That is more aligned with Blackstone at 415. So yeah, we're still very much in this situation. Even on the same block, we have disagreements about what the market is, right? But at some point, I think it is likely that sellers start realizing that the Fed rate cuts is almost like trying to start a car, right? And it just doesn't, each time they pull the key, it doesn't start. And once that becomes understood, that buyer demand's on ice and is not coming back anytime soon, that is likely when you'll see sellers maybe begin to panic a little bit. I couldn't tell you exactly when that's going to happen, but that's the key point, understanding that shift in seller psychology from going from, I think I should get X for my house because I just should, to I better sell today because it's going to get worse in the future.
Yeah, and Nick, that logic makes sense to me. And everything we're talking about here, so far, more or less, assumes kind of just the continuations of existing trends that are underway. We haven't really talked about the impact of like a bear market, right, in the financial markets here, right? Like if we get a market correction and you get the negative wealth effect on top of what's going on here, I mean, it pretty much just pours kerosene on the fire, right?
Definitely. Yeah. Stock market, of course, is in definitely some type of a bubble based on at least fundamental metrics, the Buffett indicator, cyclically adjusted PE ratio, stock market's at near all-time highs. What would happen if the stock market corrected 20 or 30%, people's 401ks went down, and then, yeah, negative wealth effect went in? That would probably spur more selling. In some ways, the current situation is reminiscent to what we saw in mid to late '07. To be clear, there are big differences between this housing cycle and that housing cycle. We don't have as many bad mortgages. But it was back in mid to late '07, inventory had grown a lot in the US. Prices were starting to drop, but stock market was still at an all-time high. And there was still this perception that we would avoid broader economic downturn. Does kind of feel that way right now. So yeah, what would happen if stocks dropped by a lot and then the unemployment rate doubled? I mean, I think all bets are off at that point. It's not something I feel totally comfortable projecting other than to say if it did happen, you'd have more mortgage defaults, you'd have more evictions. Actually, the mortgage default piece is worth talking about because historically, and I know we're maybe running a little long on this, but I think it's important people actually understand this point. The mortgage defaults, haven't really ticked up that much yet. I think we're back to a normal level of mortgage defaults today. But historically, mortgage defaults and the unemployment rate are extremely correlated.
Mm-hmm.
They're almost kind of one for one. If you look back over the last 25 years, I'm pulling up a graph right now to show your viewers this, Adam, because it's very important to understand is what's the potential downside in this scenario. So on this graph, the orange line is the mortgage default rate. This is data from the Mortgage Bankers Association, compared to the blue line, which is the unemployment rate. And what do you see? They are very linked.
Super tight correlation. Yeah.
Super tight correlation. In some cycles, maybe mortgage default rate leads. In other cycles, maybe unemployment rate leads. But, so we have a, 4% mortgage default rate through the second quarter of 2024. There's a 4% mortgage rate in the second quarter of 2024. Both are up from their lows. If this unemployment rate were to increase, it is very likely that the mortgage default rate were to increase as well. And if that happens, you could then just apply kind of a dial to everything we're talking about and turn the dial up on inventory, potential price downside. And so, yeah, you're right, Adam. It is important to think that just acknowledge that we're still in an environment where mortgage defaults and unemployment rate are historically low.
Well,
and all this is already happening.
Yeah, so totally agree. But Nick, I mean, the logic here is that unemployment is the leader here, right? Even though they're so tightly correlated. But if you lose your job, you can't make your mortgage payment. You're more likely not to be able to make your mortgage payment, right?
Mm-hmm,
so
correct.
So the light blue line here is unemployment rate, and folks who watch my channel have heard me say this many times. Look at what happens when employment bottoms and starts to tick up, right? It's always violent.
Yeah.
Right.
Yeah.
And so, if we are indeed at that part of the cycle here, if you go, over to 2023, 2024, it looks like unemployment has bottomed and we are now ticking back up. So if history repeats itself, if the historical pattern repeats itself, we should, it would not be a shock to see the unemployment rate really jump up from here, and de facto mortgage defaults should then as well.
That is correct. It's a good point, Adam. We still have sky-high stock prices. We still have a low unemployment rate and mortgage default rate. All those things are theoretically beneficial for the housing market. Even with those things, we're still seeing the weakness play out. I think the other thing I would add is watch the mortgage applications. If mortgage applications don't increase meaningfully due to the rate cut, that could also be a signal about the economy, right? Mm-hmm. That if the mortgage apps don't jump, maybe other parts of the economy won't jump either due to lower interest rates. I'm going to look at that mortgage application index not only as an indication of housing demand, but potentially of economic health and vitality as well.
Well, and speaking of health and vitality of the consumer in America, we're seeing more and more data that the consumer is getting weaker and weaker and weaker. And I can go through a whole list of things here, from collapse in people dining out to Challenger, Gray, and Christmas just put out there that layoffs soared in August, hitting their highest total in 15 years, while year-to-date hiring hit the lowest in 19 years. I mean, we're just seeing all sorts of signs here that the consumer is increasingly getting squeezed, tapping out, et cetera. And so could that be reflected in a continued drought of mortgage applications? Absolutely. So anyways, as you continue to track that and see anything interesting, please share that back with us, Nick, if you can. The only other thing I want to say about mortgage defaults is I wonder if they are delayed this time around because of the moratoria that we had during COVID. And if we're looking at other types of consumer loans, we are seeing rising delinquencies in auto loans, in credit cards. Definitely more of it in the lower, the more towards the subprime end. But we are seeing spikes in all different consumer categories in those. So I don't know. Do you think the mortgage data might be a little bit behind its normal schedule here, given that people didn't have to pay for so long?
I think you could be onto something. I think it's a tale of two stories. On one hand, you do have a certain segment of people who are going to scratch and claw to just never default on their mortgage if they have a 3% mortgage rate, right? So that's a certain reality. About 20 million people have a sub 3% mortgage rate. So yeah, there will be probably a lower mortgage default rate in this cycle. But I think your point is accurate. There was so much intervention in the market over the last 3 to 4 years on mortgages. There's still intervention on the VA side. They're doing big things to stop mortgage defaults and foreclosures. They keep trying to do things on the FHA side to do that. To your point, FHA mortgages have a big spike in mortgage defaults already, reflecting maybe a lower income, lower credit borrower feeling more stress already, whereas the conventional Fannie Mae mortgages still have very low mortgage defaults. So actually, that it is mirroring, the mortgage market is mirroring what we're seeing in some other debt markets as well. But I think you might be right. There could be a delay. The mortgage default peak is not going to be nearly as high this time in this cycle, but it doesn't need to be to cause issues, particularly in these boomtown states where we're already seeing the inventory go up by a lot.
Okay. All right, Nick, I've got a bunch of other questions, but we're going to have to save them for next time. It's always so great when you come on because you bring the data. And as you said at the very beginning of this, so much of what we've sort of been kicking around academically for the past 2 years is now actually unfolding on the ground, and it's getting real. And if you live in Florida or Tennessee or Texas or some of the states that you've focused on here, this is definitely not academic at all. It's happening all around you. So I guess as we just wrap up here, Nick, a couple quick questions. The last one is just what sort of advice would you have to folks about planning for what lies ahead here in the housing market? I'm guessing certain, depending upon what state you live in, you may have a list of decisions you might need to make a lot quicker than if you're sitting in an Illinois or a Massachusetts.
Sure. I think number one thing is just make sure you have your budget figured out. Make sure you have your peak price, your pay for a house figured out. I think actually I'm noticing a lot of people in this housing cycle have a pretty good sense of value and a pretty good sense of fundamental value and aren't overstretching themselves. That's why the mortgage applications are still so low. But really make sure you have dialed in the price you're willing to pay, the price you can afford, right? Have that dialed in no matter which market you're in. And I would say don't deviate from that, right? I mean, if you can't afford more than a certain mortgage payment comfortably, then it's probably not a good idea to buy a house. Comparatively, if there's a certain payment that you can afford, it's 20% of your income, you feel good about it, you feel like you have the down payment saved up, and then you want a good discount, proactively start going out there in markets where prices are dropping and make lowball offers and see what happens and get a sense for the market. I would just encourage people to look at the market dynamically. Don't get stuck on the fact that certain sellers are still out to lunch and don't understand what's going on. Rather, think dynamically about the market, target the areas where prices are going down, and see if you can get a deal. Obviously, not all people are going to want to do that, but I would say if you're someone who's opportunistic, the opportunity is starting to present itself in states like Florida and Texas, and will likely spread to some other states over the next 6 months. If you're a seller on the market, you really need to pay attention to the trends in your market. Like if you're a seller who actually wants to sell your house, some sellers clearly are just, okay, letting it sit on the market for 6 months and not have anything. But if you're a seller in Dallas, home price forecast score on reventure app is a 39 out of 100. This is a definite buyer's market. Do not overprice your home in Dallas if you're selling in Dallas. Do not overprice your home pretty much anywhere in Texas. Don't overprice your home in Florida because these are markets trending down. You're probably going to want to anticipate that if you're a seller who cares about selling your house quickly. Because if you don't anticipate that and you come to market in these areas in blue at prices that are too high, you're going to often end up just sitting on the market. Comparatively, if you're in Massachusetts, Connecticut, as a seller, you have more leeway. Prices are still going up in those markets. And so again, it really depends. Even going down to the zip code level, folks. I mean, we go down the zip code at reventure app and we look at the price forecast trends. You can actually see in Dallas, there's big differences. Are you in Highland and University Park? Prices still going up. Are you in most other places, south and to the east, prices are going down. You got to understand these trends in the market if you're a seller, a realtor, investor, home buyer, so you can make a more informed decision.
All right. Well, look, in terms of helping people make more informed decisions, obviously following you, Nick, is a great way to stay with your finger on the pulse of the housing market. Where can folks follow you in your work?
Sure. So the program I've showed you throughout this video is reventure app. www.reventure.app. You can access home value and inventory data for free. I would encourage you to go to your zip code and see what the trends are. If you are interested in gaining more insight, you can sign up for a premium membership on there to get the home price forecast data as well as the overvaluation rate. And if you want to see my ongoing housing analysis, follow me on YouTube here at Reventure Consulting. Reventure Consulting is my YouTube channel. I put out 2 or 3 videos a week tracking the housing market and economy.
All right, fantastic. And Nick, when I edit this, I'll put up the links to those URLs so folks know exactly where to go. Folks, they'll be the same URLs will be in the description below this video too, so you can get there with one click if you want to. And highly recommend everybody both watch Nick and get the Reventure app. Getting the app is free, and then there's some additional elements there that Nick mentioned.
Oh, sorry. Can I just add? Currently,
Yeah.
it's a web application. So currently, you got to go to www.reventure.app, but we will be releasing a mobile app for iOS and Android later in 2024.
All right. So before the end of this year.
Before the end of this year. But in the meantime, go to www.reventure.app on your phone, on your computer. You can access all the data for free on inventory and home values.
But Nick, when it does come out, let me know. We'll have you back on here. You can give folks a little demo of it live if you're able to share a phone interface here on the screen, and then we can tell folks exactly how to get that. Awesome. All right, folks. Well, look, if you've enjoyed this conversation with Nick, as I always do, and please let him know you'd like to come back on the channel as soon as he's got something else to update us on by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. For most people, these decisions about what to do, whether it's buying or selling your home, can be one of the biggest financial decisions you make, especially with all the dust that's in the air now that Nick's described for us. Can be an overwhelming decision. If you'd like to get some help with that, make sure that whatever decisions you're making around your home plug in well with your overall financial plan. Highly recommend that most people watching here seek the advice of a good financial professional advisor who can help give them some advice about the process. If you've got a good one who can do that for you, great. You should work with them. But if you don't, or you'd like a second opinion from a good one, feel free to consider a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. And again, these consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible. Last, real quickly, just want to remind folks that the early bird price discount for the upcoming Thoughtful Money Fall Conference on Saturday, October 19th, expires when this video goes out, which I guess will be Tuesday, right, in less than a week. So again, I know I've been hammering this, folks, but I want everybody who attends the conference to get the lowest price possible. So if you haven't already bought your ticket yet, buy it now to lock in that lowest early bird price. And a reminder, if you're a premium subscriber to our Substack, you get an additional $50 off of that. To sign up for that conference, just go to thoughtfulmoney.com/conference. All right, Nick, my friend, it's always just wonderful having you on here. Can't wait to see your next adventures in the next market you go to. And as you have, again, new pieces of the puzzle that emerge here, please just let us know. We'll have you come right back on.
That was great, Adam. This was terrific.
All right. Always a pleasure, my friend. Everybody else, thanks so much for watching.